Jeff, very good to see you. Today, we are going to talk through how to reduce taxes in your portfolio. A lot of us have probably heard about asset allocation before, but perhaps just as important is asset location. Where you keep your assets in a tax advantaged account or a traditional brokerage account can lower the tax bite that you have in your portfolio. So let's start high level. Can you talk through, please, the tax benefits of a traditional and a Roth IRA and how each has its own tax advantage?
Absolutely. That's right, Erin. So for a traditional IRA or retirement account, you receive the tax break up front. So it helps you with your taxes up front. As long as the funds stay in that type of account, they're tax deferred and they're not taxed until you take the money out as a distribution when you put it into your bank account. The Roth account is kind of the opposite of that. With a Roth account, there's no upfront tax break. But if you leave the money in the account for a 5-year period or up until age 59 and a half, all the distributions are going to be completely income tax free. And so, which is better? From a strictly tax perspective, it depends on what your tax bracket is going to be before retirement or after retirement.
Right.
If you expect taxes to go up in the future, then the Roth account might make more sense.
Right.
But also, the Roth account gives you more flexibility. It allows you to take distributions that are going to be a large distribution can be completely income tax free for you later.
Mm-hmm. Right. And so keep that in mind as we get to number 4, everybody. Next, though, we want to talk through tax loss harvesting. Can you explain how this works, please?
So this strategy is specifically for after-tax brokerage types of accounts where you fund the money with after-tax dollars. And so when you purchase a stock or a mutual fund, you have a cost basis. And if you tax harvesting is when you purposely sell stocks that are at a loss. And you do this to offset other capital gains. The goal is to reduce or eliminate your tax bill over time.
Mm-hmm.
So if you purposely do this, it can certainly make sense. There's rules related to this as well. There's what's called a 30-day wash rule, where you can't just sell a stock and then immediately purchase it back.
Right.
So,
Right.
but it could be a great strategy for reducing your taxes.
Mm-hmm. All right. So now let's drill down into asset location. Dividends and other cash distributions are typically taxable in the year that you receive them. To minimize your tax burden on dividends, consider where you hold your investments. What do we need to know?
Well, because your after-tax accounts throw off these dividends, and you're taxed on these every year, whether you take the money out and you spend it, or if it goes into your bank account, or if it stays in the account, you're taxed on it each year. So one strategy to consider is putting dividend stocks or dividend mutual funds into the retirement accounts. So if you do that each year, you'll still receive those dividends, but you're not taxed as long as it stays inside that retirement account. It's tax deferred along the way. So for the after-tax accounts, instead of dividend stocks, one consideration should be index funds or growth funds. These are companies, again, that don't pay dividends. They might be instead reinvesting into the company, and it doesn't throw off as much taxation onto your each year's tax return.
Okay. And then as promised, we were talking about those Roth accounts, and that is related to our last point here. Take advantage of long-term capital gains tax rates. With strategic and very proactive planning, there is a potential for a 0% tax rate.
That's right. So again, for the after-tax accounts, if you hold that stock or fund for over 1 year, then you receive favorable tax treatment, long-term capital gains rates. And there's a specific schedule for that. There's a 0% bracket, a 15% bracket, and a 20% bracket. And so if you're, for example, for married filing jointly, if your overall income, including the capital gains, is less than $96,700 for 2025, then you're at a 0% bracket for your capital gains. And so we can look at planning for this, and it may make sense to take distributions from or sell some of those after-tax accounts and still stay within a 0% tax bracket.
That's incredible. Yes, but as I hear you talk it through, clearly, again, proactive planning is key. So, Jeff, if somebody would like to sit down and speak with you about how they can reduce taxes in their portfolio or over the course of their retirement, what's the best way to reach you?
Yep, they can give us a call at 405-681-9633 or look on our website, gortonfinancial.com.
Great. Jeff, thank you so much for your time today. I really appreciate it.
All right. Thank you, Erin.